Joining us, Cameron Dawson is the Chief Investment Officer at NewEdge Wealth. Hey, Cameron, welcome back to the Schwab Network. Always good to have you.
Thanks for having me.
So tomorrow we got a pretty big set of numbers. We got retail sales, industrial production, our jobless claims, right when the market's really getting confident on a lot of these economically dependent groups. Are we going to be able to fulfill their needs?
Well, it is a pretty high bar. And one of the things that's been jumping out to us is that the equal weight ratio of consumer discretionary versus consumer staple stocks has been hitting new year-to-date news cycle highs all through the past couple of weeks, effectively saying that the equity market sees no concerns with the consumer. And that has actually coincided with rising forecasts for household consumption within GDP, meaning that when you see that ratio move higher, it typically means that people are growing more optimistic about overall consumption. The question is now the bar too high? Are we thinking that the consumer is more resilient than it actually is? And that gets put to the test tomorrow with that retail sales data.
Okay. What do you think we need to see there? How impressive do these numbers need to be? Do you see the market as pricing in like Goldilocks, stability in the economy? Or are we getting to the point where we need to see like early cycle growth, like we are heating up?
Well, it is a really good question because it's like this market is singing Queen. It wants it all and it wants it now. Because when we think about the backdrop between fiscal policy, which remains still highly supportive of growth, you're running big fiscal deficits. Now you have the added benefit of monetary policy, where you have Fed officials talking about hundreds of basis points of cuts, which means that this would be the deepest non-recessionary cutting cycle in the last 40 years. And all of this is happening in an environment where growth is above trend and resilient. And so when you're getting full out fiscal monetary into a strong environment, no wonder you have equity valuations so high. No wonder you have credit spreads so very tight. The question is, can it last? Can it stay? Because it's not about where you are, it's where you're going. And that's where we have to ask the question of, could we see possibly the Fed not cut as much going into 2025 if the economy is so resilient? Or could we see growth actually disappoint, meaning that we're underpricing the current risks for the economic growth scenario, which are our two big questions as we roll into next year.
Let's go back to a chart for a second here that fits right into this discussion, which is the discretionary trade beating the staples trade. And you've got another element added to it, which is, I think, consumption forecasts, like economic outlook. So take me through this. The black line here that's going up and to the right is where the discretionary is beating staples, right?
Yeah, this is one of our favorite charts. When you see that black line move up and to the right, it means that the market is feeling more optimistic about the outlook for consumers. When discretionary is outperforming staples, you equal weight it to remove the impact of things like Amazon and Tesla, which are big discretionary weights. But when discretionary is outperforming staples, it's a sign that the consumer is healthy. And it has coincided, as that chart shows, with rising forecasts for household consumption. It's when that turns lower that you typically have a broader risk-off environment. You typically are cutting estimates not just for GDP, but also for earnings. And that's why, if you look back in 22, discretionary underperformed staples. So we really see this as a barometer for how the equity market is thinking about the underlying growth of the US consumer, which we know makes up over 2/3 of overall GDP. So if there's one thing we watch and check every day, it's to make sure that that's still in an uptrend. And if it is, it warrants optimism about growth. If it rolls over, that's when you have to be a little bit more cautious about the forward outlook.
Okay. So right now it seems like, we don't have to throw caution to the wind, but we should be it makes sense that recession odds are dropping, right?
It certainly seems that way. We haven't made a recession call over the last 2 years as we've continued to see this underlying resilience of the economy. Now, it doesn't mean that we should stop asking the question about recession. The risk is that as soon as you stop asking it, that's when the odds of recession go up. It's sort of like a boy who cried wolf sort of paradox. So we still think we have to kick the tires on this economy and not grow complacent about recession risks. And the one thing we're watching really closely is that we do know that there's been this slowdown in hiring in the economy. We've seen companies pull back on hiring plans. Look at the JOLT survey that shows this slowing in hiring. Oftentimes in past cycles, when you see a slowdown in hiring, it is led or followed by an increase in firings. We have not seen that yet. Firings remain very subdued, but if you start to see hiring slowing down, turning into increased firings, then we probably have to increase our recession forecasts.
Okay. Cameron, what about the stair-step style rally for stocks versus a melty kind of froth up? It's one of those things that it felt like has been brewing around several corners the past year, never quite got there. Maybe at the beginning coming into this year, I think about stuff like the crypto markets that had been lagging that are starting to wake up, the small caps that are trying to break out, now 2,300 for the Russell. A few of these things that require a little bit more confidence, a little bit more risk tolerance, perhaps.
Yeah, it's such a good point because even though we see valuations back to the levels that we saw back in 2020, 2021 timeframe, as well as going all the way back to 2000, which would suggest that we are in some kind of bubbly territory, what has been missing, at least over the last 9 months, is that spark and speculative type of activity. So that would be a longer term concern for us, or a sign that at least in the short term, you're going into a bubble, which we know is destabilizing over the medium and long term. So watch things like high beta stocks versus low beta stocks. Watch things like speculative tech, IPOs, all areas that tend to require that speculative spark in order to get them moving. Crypto would be put in that bucket as well. If you start to see that because of, as I mentioned earlier, the fiscal backdrop, the monetary backdrop into a strong environment, that could be a signal that we're closer to the beginning of the end of this cycle, given the fact that usually you see that spark in speculative behavior in the last gasp of a bull run.
Okay. Cameron, in terms of assessing how deep people are exposed into risk right now, you've got to look at equity positioning that I think is pretty encouraging. It looks like it's not over its skis. It doesn't look too excessive to me. Am I reading it wrong?
Yeah. This is really interesting. This is Deutsche Bank's consolidated positioning report. And the observation here is that institutional investors in aggregate pulled back on overall equity positioning following the July peak and into that early August swoon that we had. And even as prices in the S&P 500 have climbed to new highs, you have not seen positioning get back to its stretch territory that it got to back in July. So you're still in about the 61st percentile. Back in July, we were closer to the 95th percentile, which is why we think we saw markets trade down and sideways and choppy from that point in July. Now, there's one point to mention, though, is that there are other indicators that suggest that positioning is stretched and that you have complacency in overall sentiment. Look at things like put-call ratios, look at household surveys on equity ownership. Those remain within 1% of 20-year highs. So it's not to say that there isn't this broad ownership of equities, but if you were trying to make a case for a rally and a chase into year end, we would pull up this Deutsche Bank chart simply because it would suggest that there are some players out there who need to chase and get back in to get a piece of this performance.
Wow. All right. So it sounds like there's some maybe potential melt-up chase that kind of has to happen if things go right and people aren't in the right place at the right time after a little bit of fear crept in. Cameron, you've got one company-specific look. Let's talk some Microsoft real fast because we are seeing some diversification within the Mag 7 trade. Some looking weak, some looking strong. How come this one's in your list of, I feel like otherwise, very macro-driven charts?
Yeah, it just catches our eye given the fact that it's an AI darling, the application of AI, the fact that it's now trading below its 200-day moving average. And it just speaks to how what you've seen in tech is some falling of flies, that some of the past leaders have started to stumble. It doesn't mean that there still aren't great places within tech and great opportunities, but this became a very expensive stock that saw earnings effectively flatline. And there's a message change for the overall market here. There's a huge divergence that is happening, at least in the last month or two, within equity markets. As we've made new highs, you've actually seen earnings estimates for 2025 start to turn lower. So we're running on these fumes of valuation upside. And that was the case for Microsoft earlier in the year. And now we're seeing the opposite side of that as it has to kind of grow into its multiple. So it's certainly an important message of being overbought, being very valuation extended. It can have a payback on the other side.
All right. Always some fun finds there and some good nuggets, some great macro analysis. Thank you very much, Cameron.